Good afternoon, everyone. Thanks for coming. Nice to see you here. We are going to treat the topic of hidden divergences today. In the previous webinar with me, if you remember, if you have been there, we talked about divergences, a regular classical divergence analysis. We mentioned it in the family of divergence analysis. We mentioned this type of hidden divergences and also other types of setups. Like the swing failures belonging to the same family. We had a chance also to study a bit in deep the oscillators and momentum indicators. We saw how they can lead price action in the sense that they are very sensible to what happens in price, to changes in acceleration, in speed. And there were a lot of questions and interest about this other type of divergence, which is called hidden divergence or reverse signal, depends on the author, which belongs to the same family, but it's a quite different signal, and we'll see why and how to trade it. And let me start by asking you if you are familiar with this type of setup, and if yes, if you encounter any difficulties in trading hidden divergences or divergences, generally speaking. Okay, one person says completely new, not traded yet, divergences. Okay. Okay, so that's especially hidden. Confused on entry, yeah, that's. Generally, what we said last time is that divergences as a setup carries no entry signal with it. It is a situation, a lack of confirmation between what happens in price and what is printing in the oscillator. So in itself, it's not a signal. You need to use that in combination with any other technique in order to trade it successfully. So it's like more like an alarm than a signal to buy or sell in itself. Okay, let's start here by this first block. We will see some examples of what we can say this is a trend continuation signal. And similar to the regular classical divergences, the hidden divergence, it's also discrepancy between price and an indicator, usually an oscillator, except that this is a continuation pattern. Okay, since it is a pattern which gets a trader into a prevailing trend, it has a higher probability of success. Okay, the hidden divergences, they are much stronger market situations or setups than reversals that form at fluctuating obvious extreme levels like the regular or classical divergence. You have the pound dollar is a recent chart taken from yesterday on the 1 hour chart, and using the MACD, we see several examples of regular divergences along the trend. And here is a situation that happens a lot, that during a trend, the divergence setups that are printed do not carry a convincing reversal in price. Okay, you see here these three situations until the price hits a significant reversal, or this reversal would be seen in a higher chart, which would be confluent with a reversal with a supply level at a higher chart. Until price doesn't hit that level, it doesn't start to reverse. Okay, so this is a danger trading the normal regular divergences when you are in a trend. Okay, on the other side, you have here below the hidden divergence setup printed on the MACD. Okay, that is in an existing trend, price makes a pullback, but the indicator makes a larger pullback than price. That's stretching beyond the mean. It's like a rubber band or like a catapult effect. Okay, at this point here, we would expect the indicator revert back to the mean. In that case, the mean in the oscillator would be the zero line. Okay, and it would revert back to the mean. That is what the entering price action did. Okay, so this is within an uptrend. The hidden bullish diversion would be a signal of a trend continuation instead of a reversal in trend. Okay, we'll see also later that again they can be used for obtaining price objectives. Okay, so this type of situations are relatively easy to see, but they are not obvious. Okay, in the positive reversal, we have, for instance, here another example, two examples, one with a stochastic and another one with the RSI, both oscillators. You see in the positive reversal, the RSI will develop a new oscillator low relative to a former indicated pivot when price data is at a higher level. Okay, so if we look here, the price is at a higher level than it was before, but the price or the indicator is printing an oversold situation in a deeper level than it was before. Okay, this may sound contradictory that the price is printing higher levels and the indicator is more oversold than it was before, but this is the type of discrepancy that we are looking for. Okay, as the oscillator is becoming overbought when prices are at a higher level, or at higher level. In that case, it would be the opposite situation. Okay, in a positive reversal. Okay, when the prices are at a lower level, it warns that the market is becoming to erode and become weaker. So it happens in both situations. It has to be mentioned that hidden divergences do not have to be at oscillator peaks and troughs that form extremes. Okay, you can work with support resistance zones in the indicator itself, so you can see when there is a drop rise to these zones, but it's not necessarily do they have to happen in extreme levels. Okay, it's just the relationship between one trough to the other, one peak to the other. You want to see in a continuation of an uptrend, you want to see a overbought situation that is more pronounced than the one that we had before. And yet another example of a hidden divergence in a downtrend. This time in the euro pound 4-hour chart was a recent one, and here on the bottom the RSI 14 period, and as we can see, these two peaks in price correspond to those two peaks in the oscillator, and the second one is higher than the first one. So the market is in a overbought situation of a more pronounced character than the first one, and entering price reversal at that point. Okay, we'll see that how to capture a portion of that movement, how to set up targets, and when to filter out those signals in case the ensuing price action doesn't carry over a continuation of the broader prevailing trend. You can it's advisable to seek for confluence with other indicators if you are using this setup. For instance, here we have Bollinger Bands plotted on the chart. This is a 21 period Bollinger Band set to 3 standard deviation, and we see those two peaks in price are touching the upper band okay, at lower levels in the epsilon, in the price axis, so to say, and here the divergence setup, okay. Still with the same setup, we can interpret and add to the analysis another non-correlated setup, like it could be, for instance, the interpretation of patterns. In that case of Japanese candlesticks, we have an Arami pattern, two indecision bars in the middle called dojis, and a bearish engulfing. Okay, and then this return here to the mean, which is in that case the 21 moving average. In that case, it's about returning to the mean after an overbought or oversold situation. So through the use of hidden divergences, you can also obtain price objectives, and that is what we are going to see here. Practically, what you do is you label the two peaks or the two troughs and one peak. You label them, and you do a very uncomplicated calculation. You label in case of negative hidden divergence, you label two peaks and one trough, and vice versa. In case of positive hidden divergence, like we have here, the trough is the in that case the peak is the momentum peak that is the highest level for the positive divergence. Okay, and conversely, we always look for a momentum peak that is the highest level or the lowest level in positive divergence. Okay, this means the momentum extreme point will not always be the actual price low or high, because also a regular divergence may be present here. So we take the peak here, corresponding to the epsilon in the oscillator, and we look to what closing price corresponds to that peak. In that case, it's not the absolute high on the setup, but in that case the candle before. Okay, and to make the price projection, we just subtract the close price level at X from W, and we calculate that difference, which in that case here is quite small, and we add it to the closing price at the indicator peak. Okay, and in that case we got that estimated price objective here, which is very conservative, seen in hindsight what happens afterwards. Okay, but this is one way to calculate targets by the means of this hidden divergence. Okay, another mean to calculate it, and which is probably not so conservative as the one before, is just to measure the distance, in that case from epsilon to X, from these two points, and project the same distance in the direction that we expect the price to reverse. Okay. Yes, W and X are closing prices as well. Yeah. Mm-hmm. All these points are closing prices, except that it's the peak of true. In that case, the peak in case of a positive hidden divergence does not always correspond to that spike that we have in the price action. Okay. You have the same situation, but in that case it's a negative signal, and we have the price target calculation being the closing price at this true here, and from that level you subtract the difference between W and X, which is In that case here, in this example, more pronounced. And it takes us to that level here that we see recently in the euro yen 1 hour as being reached. Okay. We may also seek for confluences of targets. Pardon. In that case, there is I use the Fibonacci tool to extend the previous move, and we see how the level is pretty coincident with a 100% level. Okay, so it's useful when using this type of target calculations to try to find for confluences amongst several methods of targeting price targets. Okay, I use here a combination of Fibonacci extension and the hidden divergence target calculation. Okay, and we see that there was a confluence in that level here. As once that target was hit, we see that there is a classical regular divergence set up. We see that there are lower lows in the price action and higher lows in the oscillator. That is a regular divergence, okay, a positive regular divergence calling for a reversal to higher prices. Okay, and this is a situation that we often see, the alternation between regular divergences and hidden divergences. And many times they form channels within the oscillator, channels which can be used to trade as well as you would do in the price structure. Okay. This is a setup that, like many other setups, do fail. Okay, and we want to see how it can fail. As for the chair is asking for the exact entry point. As I will conclude to the end of the presentation, this type of setup is more useful to calculate targets which are confluent with other levels than as an entry pinpoint technique. Okay. For me personally, it has more use as a calculation of a target or a signal that a trend continuation would be favored than as an exact entry point. The hidden divergence itself, as the regular divergence, doesn't carry with it a signal in itself. It's a situation which is when we speak of divergence, we mean there is a lack of confirmation. There is a discrepancy between what happens in price and what happens in the oscillator, and this kind of discrepancy sends out an alert. And with that knowledge, then we can apply other techniques in order to pinpoint our entry. But in itself, neither the regular divergence nor the hidden divergence have a signal attached to it. Okay, it's different with a swing failure that we spoke about in the previous webinar a few weeks ago. I think it's recorded. We spoke about swing failure, which is a specific signal traded, especially with the RSI, and that signal does have a breakout line, which would be the entry level. Okay, it belongs to the family of divergences, but that type of signal is not available with a hidden divergence. So hidden divergence can and do fail, and there are certain observations that have been made. Generally speaking, when there is no perception of what is happening in other markets, this can obviously lead as in any trading method, to failure. Okay, so a perception what is happening in other pairs, what is happening in other asset classes is always a plus. If you can follow up what is happening in the dollar index, what is happening in equities, in S&P, what is happening in bonds, and so on. So having this broader picture of key levels on those markets, on those asset classes, you are much better off to sum an edge when you want to commit to your position. Okay. So, but this is something that I would say with any type of setup, not only with divergence, but I mention it here especially because divergences in itself and hidden divergences are not as a signal in itself. Okay, it's just a situation, like I just said. Okay. Obviously, if you trade divergences of any type as a single setup with nothing else, if you don't combine it with other techniques, then you will obviously fail a lot of times, especially if you are with trading with regular divergences and the market you are trading is in a trend. Remember that that a previous example that I've shown to you, there were several divergences printed in the MACD, but all they failed. Okay, because the price heated to a key level that was above those setups. Okay, so as a single setup, it's very dangerous to trade. Okay, this would also apply to other types of setups or patterns. To use it as a single setup, it's quite dangerous. Okay, not if there is no adjusting or rescaling of indicators, this would be also a more general observation. By that I mean if you are combining this type of setups with Bollinger Bands, like in the just the previous example, or if you are using it as in itself based on any oscillator, if you do not adjust or rescale that oscillator in terms of how many periods the oscillator is calculating, then you may also have some difficulties, because we have seen this in previous webinars, how to find the best period calculation for oscillators, and it's something that you want to follow up in your testing to see if the settings that you are using, if they still respond well to what is happening in price action. It's not something that changes frequently, but you want to have always that in mind, that sometimes you have to adjust or rescale indicators when changing markets, or when markets rescale or adjust to new conditions. But this third point is also a general point, not specific about this setup, but I wanted to mention it here also. The fourth point, higher peaks and troughs, and for that we want to have a look to this chart here. This is the daily Euro Yen, and as we see, we have here three hidden divergences with the higher highs, or in that case higher highs in the oscillator, higher overbought conditions, so to say, and lower lows in price. In that case, we have a quite flat line here. That would also count as a valid hidden divergence, since the second peak in the oscillator was was higher than significantly higher than the first one. And this point here, higher peaks and troughs, or in an uptrend, or in that case would be lower peaks and troughs in the downtrend, would mean that with each setup that happens, the probability of that situation to lead to a reversal or a continuation, in that case, and a continuation of the trend diminishes. Okay, we want also to count how many periods there are in the formation of the hidden divergence, and as we see here, the periods as well as the amplitude of the signal as the trend matures, they get shorter. See that the amplitude of the setup in the oscillator is getting narrower. The amplitude would be the difference between the peak and the trough in the oscillator. That amplitude becomes narrower, and also it becomes shorter, the duration of the setup. Okay, while the first one triggered or lasted for over took 25 periods to form. The second one 22 periods, and the last one in this picture took only 15 days to develop. Okay, this is a daily chart on the euro yen. Okay, so this is something, if you test this kind of setups, you may include these considerations. Okay, these considerations. Well, as Boyke asks, as for the time frames which are good for hidden divergence, this is not a setup that is tied to a specific time frame, because what you want to see here is during a downtrend like we have here, you want to see overbought situations, and you have those overbought situations, or relatively higher overbought situations than a previous peak. You can get that in any time frame. Okay, in any time frame. Okay. There is a lot of times the question about which time frame is the best one to trade a specific setup, but I believe that most of the patterns they happen in any time frame, because price behaviors very much like in a fractal way. What you see in very small charts, you see also in higher ones. Okay, you can do Elliott wave counts on very large scales, but also on very small time frames. And the same happens with a lot of other patterns or types of setups, of technical situations, and this is no exception. So I would say you can spot for this type of setup in any time frame. Okay, because the conditions are given in really many situations, in many time frames, I mean. Okay. Also, another observation would be that the price objective, as we have calculated it before, is negated when the RSI, or the oscillator you are using, violates the trend line that connects the two momentum pivot levels used to calculate the differential for the price objective. Here we have an example. You see this trend line that we have just used to calculate that target here. You see that the price didn't hit the calculated target, and instead it broke above that line that was used to establish the hidden divergence. Okay, so once that line is broken and that level cleared on the oscillator, we know that the whole setup is no longer valid. Okay, and this also brings additional information as for the continuation of that trend. Okay, so here we start to think about a reversal in the overall trend instead of a continuation. Okay, so there are, if you recall, we had also a session on point and figure charting, and there were several ways to establish targets based on very simple patterns on point and figure charts. And one of the messages we got from those target calculations was that if any of those targets is negated because price goes in a different direction, so is the overall price structure or trend direction is also compromised. Okay, and so that they have carry this useful information also. Moiki asks if we can see them without using indicators. That's a good question. Well, it's not that we can see them, because the way the oscillator translates price action into a single line is it's not an easy calculation to do without a charting platform. It's not something that you can easily, just from pure observation, calculate and imagine how an oscillator would be printing accordingly to the price action that you are seeing. That is why we say that oscillators, generally speaking, they lead price action in the sense that they are very sensitive to any change in the speed and the rate of change of price in the acceleration. Okay, and that sensitivity you can't in my opinion get from just observing price action. Okay, but it is on the other side, it's true that by studying this type of setups, you familiarize yourself with the situation where you have a main trend, you identify a main trend, and you capitalize on those reactions counter to that bigger time frame trend. Okay, so this is somehow a counterintuitive situation in that you are seeing what could seem a reversal in a trend, and you are not adding to the trend on a breakout, for instance, of the recent low of that trend, which would be a very risky situation. Just to imagine, in that case, you would trade a breakout of that level here. You would have entered the short trade on that level. Here you would have entered the short position here, and so on. And this carries a much higher risk than entering at better levels. And if you train yourself to spot hidden divergences, finally, I think you probably get rid of the oscillator in order to spot them, because you already know what is the main trend, or you have your ways to analyze and to establish for yourself what the main direction is, depending on your time frame, and you start to capitalize on those reversals within a trend. Okay, and it's obviously not an easy situation in the beginning, because when you're selling here at that level, or just after that level, you are selling after an increase in price. Okay, and that is somehow counterintuitive. Okay, but if you know that recent rise in price which was very pronounced, very much pronounced than the previous one. And besides, you are that rise in price went straight into a level which in the recent past showed that there was a supply stronger than the demand side. Then the probabilities are that level would ensure a reaction in the direction of the trend. It doesn't mean that the trend will continue, but at least there will be a reaction in that direction. Okay. There is another question. Can you compare an amplitude of the RSI from one period to another period? I would think that value of 40 3 months ago is different to a current value of 14 if your RSI period is less than 3 months. For example, common RSI 14. Not sure if I understood the question, but as far as comparing this type of setups or the amplitude of the RSI from one period to another, this is something that I would rather rely on a back test on a specific market. What I can say is that amplitude and duration is somehow correlated. You would probably find that there is a certain correlation, and what you also may experience is that from a certain period on, from a certain duration on, you may start to see that the strength of the situation of the signal, in that case I would say, diminishes. Okay, if we have a too large duration of the setup, it may be that the force diminishes. Okay, and this is, we can probably understand it when we look to price action. If price starts to meander a large period of time, when prices start to meander in terms of Elliott waves, you know that corrective waves can start to be very complex. And again, this is a theory that explains price behavior somehow, and the information that we can gather from that is when prices start to just making time and evolving sideways with no clear direction. I do not expect that price, after creating such a large base or a large lateral price action, come up to peak a previous supply level, for example. Okay, because if prices want to continue a trend, they will not wait too long to pick that level. Okay, so when testing this type of setups, you may find probably that too large periods lead to weaker signals. Okay, and also as for the amplitude, I guess we have the same situation, that if the amplitude got too large, either your oscillator is too sensible and you are it's not well calibrated as for the cyclical movements of price. If this is, for instance, RSI 14, but if we use a shorter parameter like 9 periods or so, it becomes much nervous, the oscillator, and here you may find these situations of mega overboughts and mega oversolds alternating very very fast, and also here I would be suspicious of very high amplitudes in the oscillator, and probably I would search for enlarge the period, the number of periods in the oscillator. Ideally, the number of periods in the oscillator is half the cycle that you are seeing in price action. So if you can see any type of recent cycle behavior through the analyzing or just seeing the peaks and troughs in the price structure, ideally you choose half of that cycle to calibrate your oscillator, right? Then it will oscillate up and down nicely with the cyclical movements in price. Okay. I hope I answered the question at least partly. Okay. Gonçalo, surely an oscillator cannot lead price. It is a derivative of price. It may assist you in making a future decision of possible future price action. James, yeah, it's not that it leads in price in what future price action comes, but it leads price in the sense that it is much sensible in translating price acceleration or deceleration than the price structure itself. So if, for instance, you are driving a car and you start to accelerate, okay, you start to gaining speed. So both acceleration is going up and speed is going up. So in that case, your oscillator will be going up, okay, towards the overbought level, so to say, and you may then stay within a same speed, okay. After an initial acceleration, you maintain that speed, and if you maintain a same speed, the oscillator will, after a while, return to the median line. Okay, it will return to the median line because there is no difference between speed in the rate of change from one period to another. So if price starts to become lateral, then the oscillator comes out of overbought or oversold and meets the median line. Okay, meets that equilibrium point. But that doesn't mean that you stopped driving. So the trend is still going on. The trend is still going on, but it's not accelerating anymore. You see, and in that sense, it's said that oscillators lead price action in the sense that you can notice that even if a trend is still going in the same direction, it changes the rate of change of that direction, and the oscillator will go towards the median line. Okay, it's not something that I invented. When you speak about oscillators leading price action, it's specifically because of this property that they have. But it's surely, I understand your point, it's surely a different leading quality than you may have if you do intermarket analysis, for instance, that one market starts to move while another is lagging. Certainly a different type of leading relationship, surely, yeah. Divergence is helpful for scalping. Sure. I believe so, that the same situation happens in very short time frames as well. Yeah, absolutely. Just plot an oscillator, an RSI, MACD on a very short time frame, and you will see that during the development of a trend, you will have the same types of setups. So this is practically, if you are having a downtrend like here, you will see that the demand is trying to meet supply on previous levels printed in the price action. This is something that price needs to manifest if it wants to move on. If in a market everyone has already bought or everyone has already sold, then you don't need a lot of pressure to make prices return, because everyone is already on one side of the market. So a single change in that balance would trigger a very big movement, because everyone is already on one side. So if you want to have a full-fledged trend, you need that prices revert back to a mean and pick those orders that couldn't be filled when they wanted to. Okay, because it's not the same when you trade with a small account that you can enter the positions you want and you have them filled. But if you trend large positions, it's not a matter of seconds that you enter your position. You may trigger minutes or hours or even days to fill all the amount of money that you want to put into a position. And that will shape the price action, obviously. Okay, and you will have these returns to the mean, which is a signal that the trend is very healthy. Okay, but all in all, the idea is when I do these webinars specifically on a very specific setup, it's not so that I believe that you should use the setup, but through the information that you can learn through this type of setup, you learn also about price behavior. Okay, it's not a setup in itself, which is interesting. Is the information we can gather. Okay, as for our last point, trading observations, we have seen that hidden divergences are easy to see, but they are not obvious. Okay. We have seen that if a projected objective isn't hit, it rests credibility to the prevailing trend. Okay, this is something that is an idea that we saw also when we talked about pointing figure charts, as I mentioned. Using oscillators, it's also useful to filter the divergences using moving averages on the RSI. For instance, you may want to plot a moving average on the RSI, for instance, a 9-period and a 9-period simple moving average and a 45 exponential, and you may want to see or to filter, for instance, when the shorter 9-period is above the larger one, a positive reversal is viewed as confirmed. Okay, otherwise it's what Andrew Cardwell, the specialist about RSI trading, called a naked positive reversal. In that case, you wait for a new signal to develop that is confirmed by the averages. Okay, this is an idea that you may want to use if you want to test this kind of situation. You may also use a maximum number of periods between the pivots W and X. Okay, this is something that you can find out through testing. It will depend on the calibration of your oscillator. Okay, but it's an observation that you probably reach to when testing hidden divergences. The higher the amplitude of the divergence, the longer it will take to realize the price objective. We have seen it. The higher especially the higher the difference between the points W and X, the higher that point, those levels, the higher it will take to realize the price objective. The price objective will be further away from the actual current levels. Okay, because you are adding that level to the epsilon peak or true. Okay. You may also observe that there is a high correlation between the amplitude of the signal and the spread between the points. Okay, the duration of the amplitude, the height of the signal, and the differences in points between the peaks or troughs in the oscillator setup. Okay. May I answer another question? I don't have an example here. I'm sorry, I don't have an example. These are probably ideas that you will find if you test the signal. But as for the I don't know if you are mentioning this last point that I mentioned or the previous one, but this is an observation that you probably get if you test this kind of setup. Okay. The first setup may appear in the first setup that appears in the longer time horizon. You may use it as a first situation in order to consider finding the same setup in shorter time horizons. Okay, this sometimes happens not only with divergences. It may happen with patterns of other kinds, triangles, for instance, wedges. You may find that within a wedge, you have on smaller time frames, you have smaller wedges, like a fractal. It will develop the same pattern within smaller and smaller time frames. This is something that you might consider if you analyze a big chart and you see a very high period, and you detect or you see hidden divergence in formation, then you may want not to trade that one or to use that one as to establish targets, but to wait for smaller ones happening in lower time frames. So you are summing the probability of the first one, which is occurring in a higher time frame, and use that strength to play the smaller ones. This is also something that you may use with any other pattern that you may detect. So not to trade on the higher time frame, but to use it as an indication that same pattern is to be found on a smaller period. Okay. Another observation is that sometimes the market will change direction without developing a regular or hidden divergence on a chart. Something that we also talked about when explaining regular divergence in the previous webinar. You may have a topping formation or a bottom formation without a regular divergence. Okay. Or you may have a continuation of a trend without a hidden divergence. Okay, so do not expect to see them at every turn in the market. And then useful also to distinguish between underlying fundamentals and overriding fundamentals. I'm quoting here Mehran Farouz from Thousand Pip Club that you may know from other webinars. Practically, what is I'm saying with these two terms that I'm borrowing from Mehran is that you may have a negative underlying fundamentals, like here we have this is the daily Aussie yen in 2011. You may have this developing downtrend with a negative underlying fundamentals, but within that trend you may have good news coming on, or risk appetite, risk on for shorter periods of time, and this leads to this kind of hidden divergences. Okay, so this is something that you may use in combination, not only with in conjunction with other technical techniques or tools, but also in the overall market sentiment or and fundamental data. You want to have the same perception of what is the underlying, what are the underlying fundamentals, those which will last longer, and what is the sentiment that is overriding the market in the recent period. Okay, like we have now on the euro dollar, for instance, we have underlying fundamentals which are in fact negative, still are, but the recent rumors and facts and news are very positive. So you have this sharper reversal within a major downtrend. Okay, this is something that should be taken into account, that the same dynamics which we are analyzing with a technical indicator happens in mass psychology, which is manifested in price action, and also in the treatment that an oscillator does of that price action. Okay, so all in all, we are talking about the same thing. It's about reversals within a major trend, which are in fact not reversals of a trend, but healthy corrections within a trend. Okay, it's not easy to change the direction of a trend from up to down or down to up. Okay, and so far you want to spot this type of divergences to position yourself within the larger, the bigger forces in the market. Okay, we are about to finish. Just a few conclusions. As a trade setup, the hidden divergence, don't use it alone. We have seen that it has to be used as any other setup in combination with others. As a target calculation, seek confluences with other levels. Okay, I would rather use it as a target calculation as to pinpoint entry levels. Okay, and also being a trend following technique, we can conclude that it has higher probability of success than regular divergences. As for references, I will give you a few links here. There's on the side you can find some information about hidden divergences. There is the ITC presentation by Sunill Mangwanl in 2008, Trading the Hidden Divergence. Also an article by James Cheng, Technical Strategy, Hidden Divergence in the Forex Market. Chapter D2 of the Learning Center covers divergences of different types, and also a book by Constance Brown for the more advanced traders. I would also suggest to you. These are the links. Let me just post them here. Okay, here we have them. All right, then thank you very much for your attention. Hope that it has been useful, the session. If there is any other question, okay, then see you next time. Bye.